You do not want to miss this episode. We're digging into the Rockefeller Strategies, chapter 9 and 10. Did you ever wonder how wealthy people design their cash value life insurance policy, or how do they find the money to fund it? We're going to dig into those two things today. Hi, everyone. Welcome to Control and Compound. I'm Darren Mitchell, and joining me as always, Christina Wyatt. Christina, how you doing today?
Hey, Darren, I'm doing great. Excited to jump into another chapter of What Would the Rockefellers Do?
Yeah, this is an exciting time because kind of up till now we've been talking about how it works and why it works. But now we're really going to dig into, okay, let's get into the mechanics of it. How do we design the policy and how do we fund the policy? Because a lot of people go, well, great, I'd like one, but I don't have the money, or where will I find the money? So we're going to dig into how you can reallocate some funds to fund the policy with your current finances. So pretty excited about this.
I'm excited about it too, because now is the time where people can take action, right? Which I want to remind everybody that's listening out there right now. If you're listening, I would like you to take some action for me. If you could please like, subscribe, leave us a rating, show some support of the podcast. We would truly appreciate it, right? We do this for you. So if you could do that for me, I'd be really appreciative.
Okay, so chapter 9, let's start there. So chapter 9, great. We need this cash value life insurance policy. You need to design it properly, okay? But because we're designing the life insurance policy to maximize cash and minimize death benefit, okay, the death benefit really doesn't start too high, right? Which is good because that's going to give us more cash. We're trying to drive down the death benefit, smallest insurance costs, therefore the highest cash amount. So that's great. What Garrett talks about is the issue is because you have such low death benefit that maybe that death benefit isn't enough to cover what he gets into is your human life value. So human life value, typically a life insurance advisor's, does a needs analysis. How much do you need? Oh, we're going to need to cover the mortgage. Well, the human life value looks at it a little bit differently and says, how much value are you going to contribute to your family? So what is your income going to be over the next 10, 15, 20, even 30 years, depending how old you are? So the human life value goes, that's what we need to replace. Because if you're making $100,000 today and you're 40 years old and you're going to work another 20 years, well, that's $2 million right there that you're going to bring into the family. That's your human life value. Like, the misconception is, oh, I'm insured for more than I'm worth, or I'm overinsured. Well, you can't be overinsured because the insurance company will look at your human life value and say, what is this person's contribution going to be over their working career? And that's the maximum they will insure you for. And then we didn't even get into, well, if you make $100,000 now, would you like raises? Would you like to advance in your company or start a business or have other sources of income? So when you start thinking about what your contribution is to the family over the rest of your working career, that's your human life value. And that's really what Garrett talks about is, okay, let's get that put in place first with some of this inexpensive term insurance. The key there is make sure it's convertible. And for us, Christina, we want to make sure it's with one of those companies that's convertible to the good stuff, one of those participating whole life contracts. So it's really important when setting up that term insurance that you're dealing with somebody that's also an expert in cash value life insurance, because if you're not with the right company, then you're not going to be able to convert down the road. Convert just basically means turn it into a whole life with no medical evidence. But if that company you have the term with doesn't have a whole life or doesn't have one of the good whole lives, the conversion, you can't convert into one of these participating whole life contracts.
Yeah. And the basis of life insurance is that protection component, right? I know we talk about cash value so much, but protecting your family is a very important piece. And I love that Garrett brought that up at the beginning and said, hey, when we design these policies, we drive down the death benefit. And it's something I have a conversation with my clients about as well when we're getting these strategies put in place is, hey, this is your human life. Like we looked at it, you can have 10, 20, it's usually between 15 and 25 times your income. The insurance wouldn't bat an eye. If we drove the death benefit down, it might not be to that amount. Do not go out and cancel your term insurance when you put this in place if you have term, or make sure that you're looking at the term insurance as well. So it is an important piece from the protection side for sure.
So I was just going to add on there, Christina, one of the good things I just thought of when you said that is sometimes will have somebody who does have term insurance, but it may be with a carrier that has limited conversion options.
Mm.
So if you're setting up a whole life, like let's say today you're setting up a whole life and you have some term that may be with the wrong company. Well, if you're already asking those medical questions and getting approved for life insurance, that's a great time to go back and say, hey, maybe I can put some term in place, get that in place first before canceling the old term, but get some term in place with the one of the good companies that I can convert to the whole life down the road. So don't cancel your term until you talk to us, but certainly if you're able to put it with one of those companies that'll give you better options down the road, it kind of makes sense to do it all at the same time.
Yeah, absolutely. And once you get that term in place, you've kind of set that protection foundation as well and protected your insurability, right? Because you've got that conversion option and things like that. So Garrett does say in the book, first thing you want to do is take care of that. Once you've got that under control, now we can look at the optimally funded participating whole life insurance is what he calls it. So what does that mean? Well, he talks a bit about US products, obviously, because the book, he's from the US. So I'm going to talk about what that looks like here. Strategy's the same though. It's just that in Canada, we use a participating whole life policy. That's the type of product that needs to be used, but it is also important that it is structured properly. And this is where it really comes into working with someone that knows what they're doing. Because so many times I have run into people that have put policies in place with advisors that didn't structure it properly, and they have very low cash. They don't have access. Like all of these loans affect their cash value growth. Terrible things that can happen if it's not done right. But what we want to do, like you mentioned earlier, is we want to use the participating whole life in Canada. We want to drive down the death benefit to maximize the cash. In order to do that, we need to choose a dividend that's called paid up additions. That's going to grow your cash values and grow your death benefit with the dividend. And we want to add an additional deposit option to it. That is key. So, and some companies call it different things, accelerator deposit, but it's straight up extra cash going into that policy. It is the best part. And we want to be able to maximize that. So it's very important that it's structured to maximize cash. Now, we know that, we've talked about that, but what about the insurance companies? So Garrett has a list of things that he talks about that we have to look for in a US company. And they line up almost exactly. I might have a couple in there, but a couple things that you want to look for when you're picking your insurance company. We've talked about it before. We only use 4 companies that offer this product. There are thousands of insurance products out there, 4 that we use because they have to hit all of that criteria, just like what he says in the book. So first one he talks about, high early cash values. You should be able to access between 65, 80%, depending on how the structure is, but you should be able to access the majority of your cash in year 1 immediately. So high cash values in year 1. You want a 100-year history. That product should be at least 100 years old with historical facts to back that up. So 100 years. You want a strong dividend track record. I don't even say strong. I mean, like it needs to pay a dividend every single year. That's what we say. Our rule, every single year, that company has always paid a dividend. This one I add in here because it isn't actually in the book, but we like working with companies that have at least $1 billion in their participating fund. So shows that it's a large fund. It's got that value behind it. You want A ratings across the board. So know that company. If you've heard of that company before, that's probably a good sign. If you see their building downtown Toronto, it's probably a good sign, right? So A ratings across the board. Good loan provisions. This is important. You should be able to access 90% of your cash values, right? 90% of your cash values. And when you access that loan, it should not impact the growth of your policy. Completely unrelated to it. Cash values keep growing when you take that loan. And flexibility for funding. And I think this one's important too. There's only the company. This is where things can get a little different when you're looking at flexibility in Canada. I don't know the products in the US at all, really. But I know in Canada, there are some companies that offer a little bit more flexibility in additional deposits where you can make up deposits if they're mixed, things like that. And that can be very important. I work with a lot of business owners, a lot of real estate investors. I don't know about you, but I've never had a real estate investment finish on time. So some flexibility for deposits and making up deposits, that can come into play when you're looking at the company that you want to choose. So extremely important that you work with someone that's talking to you about your plan, how you want to access it, and they can help you decide. And our team is very happy to as well, help you pick the company that's going to work the best for you. So that's kind of what he covered in chapter 10 on what to look for when you're designing that policy.
Yeah, I love the flexibility. To your point, with the business owners and real estate investors, we look for, stuff happens. You can have a great year for a lot of great years for a lot of years, and then all of a sudden you have that bad year, or you have that expansion year, or you see a great opportunity where it takes a lot of your cash flow. How do you position your policy so you can not lose that opportunity of funding the policy that year, but go back later and do it? So depending upon your situation, that's why dealing with someone who knows what they're talking about, make sure that policy is designed properly to give you that flexibility in going back. And my only other thought on the US versus Canada, we get a lot of questions on this because there's a lot of marketing stuff, books in the US. And how does it work differently? And there's very, very slight differences. But if we think of one of the overwhelming benefits of this is the elimination of tax, the growth, the loans, death benefit, all tax-free. Well, if you think in Canada, we have much higher taxes than they do in the United States. So I believe it just works better in Canada, significantly better, because we're able to eliminate tax, and tax is a much bigger wealth destroyer in Canada than it is in the States. It's still a wealth destroyer in the States, but in Canada, higher taxes, if you can eliminate the higher taxes, that's really one of the most powerful features of this strategy. So I love that. All right, so let's move into chapter 10. And okay, so we've designed the plan. We got the plan designed properly. We're ready to go. People go, great, sounds great. Where do I find the money? How do I fund this? Where am I going to find the resources or the dollars to put into this? So Garrett gets into something he calls mindful cash management. And he's very conscious to say this is not a budget, right? People hate budgeting. Include me in that list. Budgeting is painful, but cash management or mindful cash management is all about awareness and expansion. So he breaks it down into sort of 4 different categories. You've got destructive, and that's things like credit cards, overdraft fees. That's just destructive spending. Then we've got lifestyle. Great. Fun stuff, right? Living, enjoying life, vacations, all that stuff. We all have lifestyle. Then we've got protective is another category. That's your savings, insurance, estate planning, stuff like that. And then productive. And we love productive because productive it's expenses that actually grow your wealth. So I would call them investments, not expenses, but they actually grow your wealth, like investing in you, investing in your business. So the goal here is to eliminate the destructive ones, the ones that are just wasting your dollars. Manage the lifestyle as best you can. Address the protective ones. Make sure you do have the protections in place, or you could lose it all. And then increase the productive ones. So in other words, increase those funds that we're putting in those productive categories where we can grow our wealth significantly. So that's kind of a really cool way to just break down your budget, your cash management to say, okay, these are the 4 categories where my cash is going. Let's look at each of them and how do we manage each one of these?
Yeah. And we want to put a focus, like you said, on the productive side, that investing side, but you need the foundation. And we talk about that a lot when we have our conversations, is that investing is really step number 2. Step number 1 is where do you save or store your wealth? And that's our favorite place to store our wealth is in our high cash value life insurance policies, which does fall into, that protective, which then we can become the productive. And I also feel like it falls into, he talks about a peace of mind fund where you have at least 6 months of emergency savings put to the side, which is very important. We talk about too, though, that high cash value life insurance policy can be your emergency and your opportunity fund. So once you get that set up, then you can prioritize your investing, and our favorite are, invest in you, your business, real estate, all of those great things. But we need to set the foundation first. So I love how he talks about that, setting up that foundation and including the life insurance policy as it. He also talks about the 4 I's of efficiency. And I like his. We do something similar with our wealth destroyers. So I'm sure if you've listened to this podcast before, you've heard us talk about the 4 wealth destroyers, which are taxes, fees, volatility, and spending, and they will erode your wealth. Well, he talks about the 4I efficiencies that can actually put wealth back into your pocket. So if you can focus on these, they will put money back into your pocket. So a little bit of a different take on it, but I love it. Now, the first I is IRS, which is in the US, CRA, right? So we have a C instead of an I for our first I, but it's important. If you can get a handle on your taxes, you can absolutely find the money to fund this policy, right? Taxes are your biggest wealth destroyer. We talk about it. If we can get a handle on them, we're going to get more money back in our pocket and our family's pocket. Next one, investment fees. So I guess he's right on track with what we would say. Insurance costs, if you're paying high insurance costs in other places, that's sometimes where you can save some cash there. And interest, if you can get rid of some of that interest that you're paying, that you might not need to be paying, that can absolutely find that cash flow for you as well. So you start picking away at these things.
Thanks, Christina. Yeah, it's all about efficiencies. How can we be more efficient so we can reallocate more money to those productive things? So Garrett talks in here next in chapter 10 about cash flow index tool. So he has this formula that you figure out, but I'm kind of going to give you a big picture of the formula. So it's not always about paying the highest interest rate first. So some people, when they're paying off their debts, they're like, okay, we got to pay off the highest interest first. And, that's a strategy. What Garrett talks about is how do we pay something off quickly so we can free up that cash flow. So an example would be maybe you have a 25-year mortgage, okay, but maybe you have another payment, line of credit or a car payment or something that is a smaller payment. The mortgage might be $2,000 a month and the car payment might be $1,000. But the car payment only has 18 or 24 months left on it. Well, if you're able to pay that off faster, front end that payment and say, no, I'm going to make extra payments and pay that off faster. Well, what happens is now in maybe 12 months, you freed up 1,000 or 2,000 or whatever your number is of cash flow that now you can put in those productive categories. So it's not necessarily about paying off the high interest rate. Now, if you got credit cards at 26 and 28%, chances are that's going to be a strategy to pay those off. But when you're looking at all those other loans, it's what do we pay off? What can we pay off quickly so we can allocate the money? And again, the key is once you pay that $1,000 or $2,000 a month payment off, you don't say, woohoo, let's put it all in lifestyle. You say, great, let's take that $1,000 or $2,000 a month and reallocate it into those productive assets. So that's really those efficient ones. So that's really a great strategy of not always looking at the highest interest rate or the highest loan. Look at what you can pay off the fastest.
Yeah, I love that. It really teaches you how to kickstart those savings and getting those monthly savings put in place. We do run into this question a lot when we're meeting with individuals and what can I allocate? You talked about allocating because we do talk about this as a savings account. And sometimes it's freeing up cash, but sometimes you're already saving, right? So you've got savings coming in. Think of it as a corporate business owner that has retained earnings in their corporation that they're keeping in there. They're not that efficient in there because they're not keeping up with inflation, but we hold it in cash because we need to make sure that we have access to it at any time when we need it. That is a perfect reallocation into one of these policies, right? Into your corporate savings. You use that high cash value policy. So easy place. That's, when you're thinking about what amount can I allocate towards these policies, it's typically what you're already saving on that side of things. On the other side, I run into a lot of people that have a large majority of their investments in the stock market and they're very concerned about volatility. Their fixed income's not doing much for them. And they literally just reallocate what they'd have sitting in fixed income anyways. So it's an easy, where did we find the money? Well, we just reallocated from one investment that was inefficient into one that's now working for us and creating all the tax-free returns and all those great things that come with the policy. So another place where you can find the money. So there's two places that I usually see people when they're getting started with these policies. It's either like monthly annual savings that they're taking from their salary, they're taking from their income, their business earnings, and we can dig down into that with these efficiencies. Or I see a reallocation. And for a lot of people, as you're getting closer to retirement, the reallocation side comes in handy because they don't want to be in these high risk investments, things like that, where we can reallocate it. We can get it into a tax efficient place for them for retirement, for estate planning, and all those great things. So I know that wasn't a part of the book, but I wanted to address it because it is a question that comes up regularly. It's like, if I'm getting close to retirement, I don't have the monthly income coming in. How can I do this? Oh, well, that's when we start talking reallocation versus savings monthly.
Yeah, people will come in and they're like, well, I love it, but I don't have the money to fund it. And then when we dig into where their money is now, they're like, oh, well, yeah, well, I never liked my investment over here, or this 2% or 3% fixed income that I'm worried about that I'm paying 50% tax on. You mean I can reallocate that into something that's tax-free, going to give me all the things that are better than what I already have, plus all these additional features? Or the business owners, you mentioned the business, are huge. So much retained earnings out there in the country where people are sitting on cash or sitting in inefficient or very high taxed investments.
Yeah.
So to reallocate corporate dollars is I think the best strategy business owners have in Canada.
I agree with that one. So once we've got everything optimized and we've got our cash and we've gone through all of the efficiencies, now we can set up the accounts, he says. So you want your peace of mind account, that's for your emergencies, and your wealth creation account where your whole life policy sits. Now, I do tend to think of it a little bit differently because I think that your high cash value policy as your foundation can do both of this for you. I think it's there for your emergencies and your opportunities. And I do think that wealth creation can come from other places. So borrow against your high cash value policy, invest in yourself, invest in your business, invest in all of those great things that are making you those higher returns. I like to look at it that we can do a little bit of both. There can be a mix or a lap over there between the peace of mind and the wealth creation. Then he has the living wealthy account, so your lifestyle and your enjoyment. And then I love that he adds the bonus charitable giving account. And when we look at the Rockefeller method and the strategy and what the Rockefellers do, they do talk and they do a lot of charitable giving. And I think that's a great thing to have when you're leaving a legacy and you're leaving your values and things behind. So if you can add that portion in too, I don't think that's a bad thing either.
Yeah, I totally agree. So, kind of to wrap up here, we've talked about, okay, so how do we design the policy in the most efficient way? Great, that's great. But it's also, how do we find the money to do it and really capture what you're already doing? And what we mentioned a few times now, a lot of it is a reallocation or freeing up money with cash flow, with that paying off those debts you can pay off quickly. So now we structure it properly. Now we find the money to put it in. And when you come out of this, at the end, you're going to be so much better off than when you first met with us going, well, I'm not saving in the right place. I don't have a policy set up, or I don't have it set up properly. I don't know where I'm going to fund it. And then after a couple of meetings with us, they come and they go, oh, well, I have a policy set up. I know where I'm funding it without additional money. I don't have to go out and find a new job to fund this. I am going to either be more efficient in what I'm doing or reallocate what I already have more efficiently. And we run the numbers every single day with clients, and this will change your life. If you can reallocate money to efficient assets, if you can structure yourself for long-term tax-free growth, if you can structure yourself for opportunities, if you can structure yourself, take advantage of investing in yourself, growing your business or investing in a business, maybe getting into real estate or some other fixed income. This is what you and I do every single day, Christina, not just with our clients, but in our life. We are constantly trying to find money to fund cash value life insurance policies for ourselves and inside our businesses, to fund additional opportunities, to fund our tax-free retirement, to fund someday legacies. And it is just such a peaceful way to live, because when you do all this, with certainty your cash is going to go up every year. With certainty the death benefit's going to be tax-free. You with certainty when you need access to money for an opportunity or emergency, you can access money, no questions asked. It's just that we're providing certainty when most people are worried about uncertainty. And that's one of the reasons I absolutely love this concept. All right. Thanks for watching. Thanks for listening. Have an awesome day. Thanks for watching that episode. Don't forget to subscribe to our YouTube channel. Click that like button. Hit that bell button so you never miss an episode. And if you want to learn more about us, go to controllandcompound.com. We'll see you next time.
Thank you for tuning into this episode. The information contained in this podcast is for informational and entertainment purposes only and is separate and apart from the wealth coach services provided by Darren Mitchell and Associates, Inc. to its qualified clients. Control and Compound Financial expressly disclaims any and all liability or responsibility for any direct, indirect, incidental, or any other damages arising out of any individual's use of this podcast or the information in it. The views expressed here are those of each participant and guest and not necessarily those of or endorsed by Control and Compound Financial, its affiliates, subsidiaries, and their respective directors, shareholders, officers, or employees. For full disclosure, visit controlandcompound.com/podcast-media.